Welcome back to the deep dive. If you have been looking at the charts, particularly over the last few weeks, you know exactly why we're dedicating this time.
Oh, yeah.
The Bitcoin price action has felt, to put it mildly, just weird.
Weird is a good word for it. Mechanical, almost.
Exactly. It tagged that incredible high,
Yeah.
near $126,000. Conviction felt like it was peaking.
Everyone was expecting the next leg up.
Right. And then instead of that rocket ship into the stratosphere, it just began this frustrating mechanical grind down.
It's been stalling, reversing, grinding toward the $80,000 range. And you're right, it doesn't feel like a normal, organic, volatile pullback.
No, it feels calculated, like something institutional, something structural is holding this asset back.
And that feeling, that sense of a calculated restraint is exactly the mystery we're here to solve today. We've spent the last week digging through a truly massive stack of sources.
What are we looking at? Analyst reports.
Analyst reports, institutional commentary from some major funds, and some really deep dives into derivatives data.
Okay.
And what we found suggests that this price compression, it's not random, and it's not driven by some, fundamental weakness right now.
So what is it?
Buried in all that data are these cold, hard institutional clues about massive market mechanics at play.
Okay, let's unpack this immediately, because the big picture hook here is that we aren't just looking at daily candles, we're looking at the foundational structure of the market.
That's it. Specifically, a gargantuan options expiry event that is coming up very, very fast.
And our mission for this deep dive is to understand how this colossal derivatives positioning has been creating a temporary financial cage around the asset.
Right. We're going to get into some pretty technical concepts.
Yeah, things like gamma and max pain.
Yeah.
We need to explain what those really mean for you, the listener.
Yeah.
And most importantly, what happens when this $23 billion cage door finally swings open?
We're going to walk you through the numbers, the sheer scale of this expiration. We'll explain why the current trapped price might actually be lying to you about the true underlying health and the fundamentally bullish positioning of the market.
So we're really examining this structural tension.
A tension between the traditional financial players who, enforce certain rules through these derivatives and the underlying exponential trend of Bitcoin itself.
All right, so to start, let's zoom out. Let's look at the fundamental philosophy that's shaping institutional thought. Because one major institutional voice recently provided a conceptual framework that, for me, completely reframes how we should be looking at these dips.
I think I know the one you mean.
They describe Bitcoin as fundamentally an asset of fear. And that is a powerful, if maybe a slightly counterintuitive starting point for an asset that's so often pitched as just pure speculation.
It is, but it instantly gives you the necessary context for the volatility we've seen. If you treat Bitcoin purely as a risk-on, a growth technology asset, its recent behavior makes absolutely no sense.
Retreating after a major high, yeah.
But if you start to see it as a hedge against global, systemic, geopolitical uncertainty, as an asset of fear, then the price shifts we've seen, they suddenly click into place. They become logical.
And the sources really detail this correlation.
They do very clearly. They show that the price is acting like a kind of barometer for global stability.
Okay, can we get into some specifics here? Because geopolitical uncertainty can be a very vague term.
Of course. Let's take two recent moments where you saw a kind of de-escalation narrative globally.
Okay.
When the initial conversations surfaced this week suggesting a potential settlement in the ongoing conflict in Ukraine, the sources point out that Bitcoin's price reacted almost immediately.
It fell.
It fell a measurable amount. It pulled back because the perceived threat of a wider systemic disruption, it just lessened slightly.
And there was another example earlier this year.
Right, with China. When there was that surprising constructive talk of a trade agreement that de-escalated global trade tensions, what did we see?
An immediate shift downward in Bitcoin's price.
Exactly.
So in both of those cases, the market was basically pricing out the need for the ultimate insurance policy. When global fears go down, the demand for the ultimate fear asset, Bitcoin, it recedes a little.
Precisely. And that's what causes these price shifts. It completely reframes the narrative for the long-term holder. You're not just buying some highly volatile speculative growth stock.
You're buying insurance against chaos.
You're buying insurance, and that insurance premium, it fluctuates based on global anxiety.
And the commentary you looked at, it breaks down those fears, the drivers of that long-term institutional demand, into a couple of categories.
Two core categories, yeah. The first is the fear of physical security. This is the profound fear of confiscation, of instability, or, the need to flee a country quickly.
A classic use case.
Right. Bitcoin provides an asset that is confiscation resistant. It's easily portable. I mean, you can memorize 12 words and cross any border, and it's outside the control of any single sovereign authority.
That's the original digital gold thesis, but just amplified by all our modern political and financial risks.
Exactly. And the second category, which is maybe more relevant to the TradFi perspective and the institutions we see driving the price now, is the fear of financial security.
What does that entail?
It means fearing the systematic debasement of traditional fiat assets, fearing the long-term impact of, soaring government deficits, fearing sovereign risk.
Particularly the risk of central banks losing control.
That's the big one, losing control of inflation. These are the profound long-term fundamental reasons that institutional money is holding this asset as a non-correlated hedge.
But the flip side, the corollary to being an asset of fear, and one that exists outside the normal system, is that inherent, often jarring volatility. The source material acknowledges this huge drawdown we've seen, right? A 20 to 25% drop from the recent highs.
It does.
And if you bought in near 125,000, treating this purely as a short-term trade, you're now sitting on a pretty substantial loss and probably questioning everything.
And that's the critical lens of time preference. If you treat this highly volatile asset, which, historically has these huge drawdowns, often 30% or more, even in a bull run, if you treat that as a short-term trade, you have to be extremely skilled at timing the market.
Which most people aren't.
And the general consensus among the analysts we reviewed is that most people, and that includes many institutional traders, are not. They're just not that good at it.
So the volatility is kind of the gatekeeper. It's what scares away the impatient money.
It does. But if you're approaching this as a true long-term hedge against systemic failure, then these short-term dips are, they're just noise.
Right.
The core insurance impact on your portfolio is still meaningful, and you actually see the dips as buying opportunities, not as a reason to panic. The volatility flushes out the fast money, and it stabilizes the base of long-term holders.
Which brings us directly to the mechanical constraints imposed by the institutions. I mean, the institutionalization we've seen specifically through things like the ETFs and these massive derivatives contracts, it means that traditional finance, or TradFi, it now dictates the macro price structure.
For better or for worse, yes.
So the asset, at least in the short term, has to follow the rules that TradFi sets.
That's a crucial transition point. The market is no longer just this free-floating entity reacting only to, mining difficulty or retail sentiment.
We saw proof of this, right?
We saw direct evidence of this market discipline right after the price rejected that $125,000 region. It began that pullback, and the analysts pointed to a very specific reason why it had to pull back.
The CME gap.
The CME gap. There was a gap on the Chicago Mercantile Exchange futures chart that would have been created or, left unfilled otherwise.
So for listeners who may not be steeped in futures trading, what exactly is a CME gap, and why is it so, sacrosanct to traditional finance?
Right. So a CME gap happens when the Bitcoin futures market on the CME closes on a Friday afternoon. But the underlying spot market, crypto, it keeps trading 24/7 over the weekend.
So there's a disconnect.
A big one. If the price moves a lot between that Friday close and the Sunday evening open, the price jumps on their chart, and it leaves this empty space. That empty space is the gap.
And why is filling that gap seen as basically mandatory?
It's a psychological and mechanical obsession for traditional, typically quantitative traders. They treat that gap like a technical debt that has to be settled.
It's like a pattern they trade on.
It's a high probability pattern. Historically, over 90% of these CME gaps eventually get filled. So TradFi, which relies on pattern recognition and technical analysis, basically demanded that this recent gap be filled.
And because they control so much of the macro liquidity now,
their demand acted as a constraint. The price was, for all intents and purposes, mechanically compelled to fill it. It's fascinating, right? It's this almost paradoxical constraint on an asset that was designed to be unconstrained by convention.
Yeah, that rigidity is precisely why we have to look beyond just spot trading and into the derivatives market, which is where the real price constraint is right now.
That's right.
Okay, so now we get into the core mechanism. We've established that the recent chop, the fake outs, the stop hunts, and this overall maddening, frustrating price action, It's not some shadowy conspiracy
Oh, no.
or some sudden retail weakness.
Yeah.
It is the predictable mathematical outcome of market mechanics involving very specific key players.
Option dealers and these huge institutions hedging billions in derivatives.
This is where the structural trap is being strung.
This is the smoking gun. And the date is absolutely critical, December 26th of this year. We have to look at the sheer scale of the options expiring on that single date because it provides the entire explanation for the current price suppression.
Let's talk numbers, because they really do. They stop you in your tracks.
The scale is immense. So for this single expiry date, we're looking at a total of 268,267 contracts outstanding.
Okay. And in dollar terms.
When you translate that into real money, or more accurately, the underlying value those contracts control, we are talking about a notional value of over $23 billion.
$23 billion.
Yeah.
In a single day. So for our listener, we need to contextualize notional value. What does that actually mean versus, say, the premium someone paid for the option?
Excellent point. The notional value is the total value of the Bitcoin that underlies the contract. So it's the size of the position that's being bet on. The premium, what the option buyer pays, is tiny by comparison.
But the notional value, that's what matters to the dealer.
That's the measure of risk that the dealer, the seller of the option, has to manage. That $23 billion is the risk exposure that is set to either settle or just vanish. And to put that in perspective, that is more than 1%, 1% of Bitcoin's entire circulating market cap that is set to structurally change in a single day.
The sudden evaporation of the risk management needed for that much capital, it's huge.
You can't overstate it.
And the distribution of those contracts is just as telling, because it reveals this significant, though currently suppressed, bullish asymmetry. The conviction is clearly on the upside.
That's right. If we break down the contract distribution, the institutional positioning is heavily skewed toward upside calls. We have almost 195,000 calls, those are the bullish bets on higher prices, versus only about 73,000 puts, the bearish bets.
Which gives us a very low put-to-call ratio. What was it?
0.38.
A ratio that low means the vast majority of the money is betting on prices well above where we are right now.
Exactly. That positioning just screams bullish conviction. But and this is the key, because these options were sold by dealers and are being actively hedged, that collective bullish sentiment is temporarily locked in a cage.
So the call buyers are waiting for a breakout.
And the dealers who sold them those calls are doing everything in their power to prevent that breakout from happening.
Which brings us to the concept that drives this entire structural trap, max pain. This term gets thrown around and misused all the time, but we need to define it precisely in the context of this massive $23 billion expiry.
Max pain is, it's actually pretty simple. It's the calculated price level at which the maximum amount of options contracts expire worthless.
So it's maximum pain for the buyers.
For the option buyers, yes. The ones who took the bullish or the bearish bet, they lose the most money. Conversely, for the dealers and institutions selling these options, max pain is the level where they maximize their profits.
They minimize their payouts.
Exactly. It's the point of maximal premium extraction for them.
And for this specific, staggering December 26th expiry, what is that gravitational center? What's the number?
The specific max pain level cited across all our sources is $96,000.
$96,000.
That number is acting as the anchor. It's the gravitational center that the price is currently being pulled toward. Dealers have every financial incentive, we're talking potentially hundreds of millions in profit optimization, to pin the price around that $96,000 level leading into the expiration date.
Wait, I have to inject some skepticism here. Are you telling me that these big financial players are essentially manipulating the price to maximize their profits? That sounds like a conspiracy theory.
I get that, but it's not manipulation in like the illicit sense. It's hedging optimization. It's driven by financial obligation and incentive. Dealers have taken on massive risk by selling all these options, and they are required to manage that risk.
And the most profitable way to manage it
is to ensure the contracts they sold expire worthless, or at least far less valuable than the premium they collected in the first place. They don't want the price to run significantly above $96,000 because then they'd have to pay out all those call holders.
And they don't want it to crash either.
Right. They certainly don't want it to crash below $70,000, as that would trigger expensive payouts to the put holders. $96,000 is just the mathematical sweet spot for the house, and they use their considerable capital to steer the price toward it.
So we are connecting the dots between the mechanical pressure and all the market noise we've been seeing. This isn't just random selling.
Not at all. As one analyst put it, options don't just sit there. Big whales hedge them. And when there's heavy positioning around certain strikes, price starts getting pulled towards that optimal point of liquidity, the max pain anchor.
And that explains the frustrating engineered volatility.
Absolutely. It explains why we see the price grind up, only to be rejected near what are known as call walls, those highly concentrated bullish strike prices.
Why? What are the dealers doing?
Because the dealers are actively selling futures or spot Bitcoin to neutralize their delta risk on those calls. Then it dumps, but buyers, often other dealers re-hedging or institutions anticipating the eventual break, they step in just before it crashes too far below that max pain zone.
This continuous push and pull, this engineered chop.
It is the precise mechanism designed to keep the price anchored near that $96,000 max pain point until the contracts finally settle.
This anchoring mechanism, this perpetual motion machine that's designed to extract premium, it leads us directly into this highly technical but absolutely crucial concept of gamma. Gamma is the engine that's driving this whole trapping mechanism. So for listeners who are new to derivatives mechanics, let's use that analogy from the source material to define this key term before we apply it to the market.
Right. So gamma is essentially a measure of how hard the options dealers have to work, or, how frequently they must trade the underlying asset Bitcoin spot or futures to maintain a neutral and safe hedge as the price of Bitcoin moves.
So it's basically volatility risk management.
Distilled down to its essence, yes.
Let's go back to that lemonade stand analogy to make this sticky for everyone. You, the dealer, you're selling futures contracts options on the price of lemons, the underlying asset. You promise some kids that if the price of lemons goes up dramatically, you'll give them free lemonade. To protect yourself against that future liability, every time the lemon prices jump even a little bit, you have to quickly run out and buy more actual lemons or sell futures to maintain a neutral position.
That running around to adjust my hedge, that's what we call delta hedging.
Right. And gamma is the measure of how quickly you have to change that delta hedge. The faster and more frantically you have to run around buying or selling lemons for every tiny price change, the higher your gamma exposure is.
And in the current market, the dealers are in what's called a short gamma position because they sold so many calls, which means they're being forced into a highly unfavorable hedging cycle.
And what does that short gamma mean practically? It means the dealer's work increases exponentially the further the price moves away from their sweet spot. They are forced to chase the price.
Exactly. If the price of Bitcoin starts climbing, the dealer's short calls start increasing in value very, very rapidly. They suddenly realize they are exposed to massive losses, so they have to frantically buy spot or futures to hedge.
But that forced buying pushes the price even higher,
pushing them to buy more in a vicious cycle. That cycle is what creates the insane volatility when the market finally breaks free. But right now, we are trapped in the middle. We're in the gamma cage.
And the source material points out that this current gamma positioning is creating a definitive, tight price cage. Bitcoin has been literally trapped between, $85,000 and $90,000, driving everyone mad.
It has. And that specific level of $88,000 is cited as the current bane of existence.
The bane of existence.
That $88,000 region is the gravitational sink right now, because that's where the maximum amount of the current short-term option hedges are centered. The high concentration of gamma positions right around that level forces the dealers into a highly active, yet market-neutral strategy.
So they're compelled to become the market's primary suppressor until December 26th.
That's their job right now, yes.
So describe that active dealer strategy day-to-day inside that $85,000 to $90,000 cage. How are they actually performing this market suppression?
It is mechanical, and it's entirely predictable, which is both the genius and the frustration of it. Because they're short gamma and actively hedging, their rule is simple.
Okay.
They sell into rallies above the $89,000 level, actively reducing the upward momentum and pushing the price back down toward the center.
And on the downside.
Conversely, they buy the dips below the $87,000 level, preventing a catastrophic crash because they need to maintain some sort of hedge neutrality.
So they are selling strength and buying weakness. They're acting as the perfect counterforce to any kind of volatility.
Precisely. This perpetual cycle of selling strength and buying weakness is what keeps the price totally and utterly trapped. And while they're keeping the price locked, they are harvesting the time decay, what option traders call theta, on all those options they sold.
Driving the price toward that larger $96,000 max pain target.
It's a game of collecting premium through enforced boredom.
But this structural suppression can't last forever. We have this massive expiry coming. And the sources are warning that this whole structural arrangement is setting up a huge volatility surge, a true liquidity event.
They absolutely are. One analyst warns of a massive $450 million gamma flush that's expected over the next week, leading directly into the expiry.
A gamma flush.
And they call it a double-barrel liquidity event. We need to parse that phrase. Double-barreled implies two massive pressures.
What are they?
First, you have the pressure that has been built up, the coiled spring. And second, the simultaneous removal of the structural mechanism that's been holding the lid down.
So what does a $450 million gamma flush actually represent in terms of capital? Is that money instantly going to enter the spot market as buying pressure?
Not directly as buying pressure, but as risk removal. It means $450 million worth of hedging requirements are suddenly lifted from the dealer's books. They no longer have to spend time and capital selling strength or buying dips.
The job is done.
The job is done. The prediction is that this event will wipe out 67% of the entire derivatives board clean by the December 26th expiration.
67%, two-thirds.
Two-thirds of the current structural constraint just evaporates into thin air. And when two-thirds of the mechanism pinning the price down disappears, the natural trend takes over almost instantly.
And there's a massive irony in all this market sophistication, isn't there? We talk about Bitcoin as this decentralized, revolutionary, exponential asset. And yet, these legacy finance institutions, these dinosaurs of traditional banking, as the source calls them, are currently harvesting premiums by playing this very short-term game of selling calls and puts. They are, in essence, betting on the market becoming bored and constrained.
It's the ultimate irony. They're playing a zero-sum game of short-term volatility suppression. They are masters of extracting profit from time decay, playing checkers to maximize their quarterly derivatives returns. But Bitcoin, fundamentally, is an exponential asset that's poised to play 4D chess.
So this is a temporary condition.
This whole derivative game is a short-term constraint, not a long-term trend reversal. Once the dealer's influence vanishes, the underlying structural forces will reassert themselves with incredible speed.
So let's fast forward. It's December 26th. The contracts expire. $23 billion in notional value vanishes. 67% of the derivatives board is wiped clean. We've described the mechanism vanishing, but what happens to the price action when that structural suppression is released?
The entire market environment fundamentally flips. The dealer's primary price suppression tools, their short gamma position that's been forcing them to act as counter-trend traders, they evaporate instantly.
The gamma wall is gone.
The high gamma wall that forced them to sell rallies is suddenly irrelevant. And crucially, building a new effective gamma wall, it costs time, and it costs hundreds of millions of dollars in capital deployment.
And you have to remember the calendar.
Exactly. We are entering the thinnest liquidity period of the entire year, the holiday week. They are not going to rebuild that suppression mechanism overnight. The structural headwind just disappears.
And when that constraint lifts, the market, which has been artificially trapped, is now free to revert to its underlying mathematical trend. This is where that massive bullish asymmetry we talked about earlier kicks in.
It suggests the market is a coiled spring, ready to release just years of suppressed energy.
And this isn't just a feeling.
No, it is more than just a feeling. It is mathematically quantifiable. We need to introduce the concept of Bitcoin's mathematical fair value, which is calculated using the power law. This model tracks Bitcoin's exponential long-term growth curve.
Not as a linear asset.
No, as a network effect asset that follows these logarithmic regression bands.
Can you explain the power law model just briefly? Because it's a critical part of validating this massive upside potential.
Absolutely. The power law model uses a logarithmic function to chart Bitcoin's price over time. It recognizes that the price growth, which is driven by halving cycles and adoption, is exponential. It gives you two bands, a lower accumulation band and an upper extreme band.
And a line in the middle.
With a central regression line that represents the mathematical mean, or the fair value. Based on where we are in the cycle and the age of the asset, that mathematical fair value is currently cited at $118,000.
$118,000. So if you compare that fair value, which is where the price should be if you weren't being mechanically suppressed, to the current trapped price, it suggests a substantial quantifiable discount.
That discount is immense. We have a minimum of a $30,000 plus discount per coin versus the asset's underlying network value. The market is not reflecting its fundamental valuation precisely because of this mechanical suppression game being played by the derivatives desks.
So when that influence vanishes,
When that active influence vanishes, the gravity pulling it toward the $85,000 to $90,000 range loses its pull, and the asset is free to accelerate toward that $118,000 mean.
and history suggests we know what happens next. Post-expiry, volatility just explodes, and Bitcoin snaps back to its trend.
The precedent is undeniable. The sources are already warning of a sharp increase in volatility ahead of and immediately following this $23 billion unwind. The uncertainty around the massive expiration is resolved, and the underlying structurally bullish forces, that 0.38 put-to-call ratio, the ETF flows, they can finally take over.
So let's define the exact trigger for that upside acceleration. If the market is a coiled spring, what is the action that breaks the cage door and lets all that energy release?
It comes down to that critical gamma level flip. We noted the strong bullish positioning earlier. Calls are heavily clustered at 100,000 and 120,000.
Right.
But the key level we have to watch is $88,500. If the price manages to flip the structural gamma level, which is cited at 88,500, the entire dealer strategy reverses instantly.
Okay, explain that crucial mechanism flip in detail. Why does breaching 88,500 suddenly turn a headwind into a massive tailwind?
Remember that short gamma position? Below 88,500, the dealers are comfortably selling into strength to push the price back down toward the center. But if the price breaks meaningfully above 88,500 and holds, those dealers suddenly realize their short gamma position is fully exposed to the upside. They transition from a negative gamma posture to a positive one, or at least one that requires them to start aggressively hedging.
Which means they stop acting as the market's suppressor.
They switch roles completely. To maintain a safe hedge, they have to switch their behavior from selling spot and futures into strength to actively buying spot or futures to catch up with the rising price and cover their now exposed call positions.
So they are suddenly forced to chase the price higher.
They're forced to chase it higher to cover their risk, which is exactly the kind of forced buying that creates a squeeze.
And this forced buying, fueled by the market's underlying bullish positioning and the low leverage, creates a massive squeeze, a vacuum, right toward that $118,000 mathematical fair value.
Precisely. With ETF flows expected to continue ramping up substantially in the new year, and the massive dealer counterflow, that structural suppression now gone, we are looking at the conditions being set for very aggressive, structurally validated moves into January.
It's the definition of a structural tailwind replacing a major structural headwind.
That's it, exactly.
Beyond the immediate derivatives mechanics, it's absolutely vital we look at the health of the underlying market. Because if this recent sharp pullback was truly fundamental, if the asset itself were broken, we should be seeing panic, high leverage, massive outflows.
And we're not.
But the data suggests quite the opposite, starting with a fundamental shift in the investor profile.
That shift is arguably the most encouraging long-term factor we're seeing. We are moving away from the retail investor profile of people who are, here for the very quick number go up.
The FOMO buyers.
FOMO buyers who often bought the peaks. That impatient money has largely been flushed out of the system.
So what are the new entrants looking for? How do they differ from, say, the 2021 cohort?
The new class of investors entering the market now has a drastically different and much longer-term horizon. They are generally more sophisticated, they're more informed about the long-term fundamentals, and they're coming in with the expectation of tripling or quadrupling their money, not in 6 months, but over the next 3 to 4 years.
So they're accumulating, not trading.
Yes. This signals maturity, long-term conviction, and stability, which is a key healthy characteristic for any emerging asset class that's undergoing this kind of institutionalization.
Another massive health indicator, which speaks directly to the market's stability during volatility, is the current state of leverage in the system. The sources suggest the market is surprisingly clean and deleveraged right now.
It is remarkably clean, which is why this dip hasn't caused a catastrophic spiral. The leverage was relatively low even before this recent decline started.
And after the crash.
After the recent 20 to 25% crash, even more leverage was flushed out of the system through liquidations and forced deleveraging. This is crucial because high leverage makes the market extremely brittle. It makes it susceptible to cascade failures.
Where one small dip triggers margin calls and forced selling, leading to a much bigger crash.
Exactly.
But hold on, I have to represent the skeptical listener here. If leverage is so low, doesn't that just mean interest is drying up? How do you distinguish low leverage, which is healthy, from low participation, which would be unhealthy?
That's a brilliant question because they can look similar on a superficial chart. We distinguish between them by looking at the type of participation.
Okay.
We see low speculative leverage, meaning fewer people betting 10x on short-term movements,
Uh-huh.
but we see stable, persistent long-term spot accumulation and strong ETF flows. Low leverage in this context means the risk is distributed across long-term holders, not concentrated in the hands of fragile, highly leveraged derivatives
So
traders.
the base is strong.
The base is strong, and it's just waiting for these structural constraints to lift.
And when we compare current Bitcoin leverage to historical standards, the difference is stark enough to show this newfound maturity.
It's very stark. If you look at the leverage expansion we saw across broader crypto during prior cycles, especially 2021, and you compare it to where we are with Bitcoin today, the current leverage ratios are significantly lower. We're talking close to 40% of the excessive amounts we saw previously.
Wow.
And here's the real irony. Current Bitcoin leverage is actually below the general leverage levels you see in broader regulated securities markets.
So Bitcoin is behaving more responsibly than the average stock index?
In terms of leverage, yes.
So low leverage isn't a sign of a lack of interest. It's a sign of a strong foundation. And it suggests there's immense room for future sustainable expansion when the rally really begins.
Exactly. This low leverage is a profoundly healthy characteristic, and it allows for significant non-volatile room for expansion. And the expectation is that much more of that capital and leverage could start stepping back in, particularly when traditional banks and institutions start lending more aggressively, which is projected to happen over the next year.
So this coming expansion will be built on a far healthier, more stable base than we've seen before.
That's the thesis.
So we have healthy long-term investors, we have a structurally clean market because of low leverage, and we have structural price suppression due entirely to derivatives hedging. And this all leads to the ultimate paradox. The funniest part, as one of the sources called it, of the current situation.
The ultimate paradox is that despite all the volatility, all the noise, and the deep drawdowns that have occurred over the past few weeks, nobody, not one major analyst, can actually come up with a good fundamental reason for why we are having this crash.
There's no why.
There's no why. The utility hasn't changed, the adoption narrative is stronger than ever, the demand isn't drying up.
So the very fact that market analysts cannot find a fundamental reason for this sharp price movement, it just strongly reinforces the core thesis of this entire deep dive.
Which is?
The movement is purely mechanical. It's driven entirely by these derivative hedging games designed to optimize dealer profits, and not by some structural failure or lost conviction in the asset itself.
It means the noise created by the options market is currently deafening the signal from the underlying fundamentals. Once the noise of the $23 billion expiration clears, the true strong signal, the demand for the asset of fear, the power law valuation, that will be revealed.
So let's bring this home for you, the listener. The core takeaway from this expensive deep dive is clear. The frustrating, choppy priced action you have been witnessing has been overwhelmingly controlled by institutional derivatives hedging.
Specifically, the need to pin the price near that $96,000 max pain target, which has been facilitated by active gamma suppression.
That structural suppression, which has been locking the market in a tight cage around that $85,000 to $96,000 range, is set to vanish on December 26th.
And given the massive bullish asymmetry in the contract positioning, we're talking almost 3 times as many calls as puts, the market is structurally positioned for a large upside move.
The disappearance of the dealer counterflow, coupled with the low underlying leverage and that mathematical fair value of $118,000, it all suggests the spring is ready to uncoil with tremendous force.
Absolutely. The data is screaming about an aggressive move into January, particularly if that critical gamma flip at 88,500 is breached.
Which would force the dealers to switch from actively suppressing the price to actively buying the rally to cover their own risk.
Right. Of course, nothing in this market is guaranteed, and managing risk and doing your own research is, it's non-negotiable.
But if the data holds, the market is on the cusp of an epic structural change, transitioning from being defined by its derivatives constraints to reverting to its powerful long-term trend.
It could be a very interesting start to the new year.
And here is the final provocative thought for you to chew on. The options game reveals this deep and immediate tension between the established rules of traditional finance, which demands stability and predictable pricing, hence that $96,000 max pain pin, and the exponential disruptive nature of Bitcoin's power law valuation, which is sitting $30,000 higher at $118,000.
So the question is,
How quickly will the market revert to its inherent trend and shrug off the last remnants of these legacy Wall Street maneuvers once the holiday expiration is finally over?
that tension is what will define the market's trajectory in the new year. Thank you for joining us on this deep dive.